So
So, what are we talking about today, Lewis? Good
today
morning.
we're going to talk about the art of selling. It is one of my
Is it an
favorite
art or a
topics.
science?
It is an art.
It is an
And
art indeed.
you can, I don't know, I thought you would throw me out a bunch of questions and then I'll throw you out a bunch of questions. What do you think
All
about
right,
that idea?
that
So
sounds
why don't
good.
you start with me and then I'll jump on you and then we'll have some fun. The main thing is have some fun. So
Yeah. So, um,
Prost, a fresh cup of instant coffee, which is, according to JP, would basically make you equivalent to an animal. So, because it's not freshly pressed.
well, there's a very nice head of crema on that instant coffee. This must be some primo stuff.
Yes, here's to some coffee and some coffee market talk.
Yeah. Apparently, you
Or
can
market coffee talk. What is it? What's better, coffee market talk or market coffee talk? I think market coffee talk.
market coffee talk. I think that's what I've heard it being referred to in the on the social media. There's a lot of talk about these recordings, by the way.
Oh, really?
Oh
Like
yeah,
which kind of recordings?
ours.
Oh, really?
Yeah, we're going viral, Liz.
Sweet. That's what we want.
Yeah.
We want to provide value. So we want to bring things to the table that we're working on that we think are going to help other people. And I think selling is probably one of the biggest things we could be working on right now for talking about selling, because it is on everybody's mind. There's been quite a bit of it going on lately. And, so I don't know. Shoot, give me some questions, JP. What do you think people want to know about selling that I can start answering questions about?
Yeah. So maybe let's try to answer the three basic questions about selling, which is why sell, when to sell, and maybe how much to sell. So I think when you think about selling, those are the questions you should answer, right? So let me start maybe by my philosophy, right? So when we own stuff, stocks in a portfolio, I always go back to basic. Maybe call me old school. If you've watched this, you probably see that I'm kind of old school in some ways. And I go back always to know what you own and why you own it. So if I just throw that out there, right? If you look at your portfolio and you review it on a daily basis, and you're like, okay, do I know what I own? Do I know what I need to know about these companies? And do you know why it's in the portfolio? So tell me a little bit, why would something change to that stance? What would make us act on something?
So know what you own and why you own it. So I think the philosophy behind that would be, if you know what you own and why you want to own it, then if something changes with the why, then you sell it. That's, in other words, if the reason why you bought it changes, then you should sell it. That's kind of you're right. That is an old school way of thinking. And I think that's true in terms of in the long run. It's very true in the long run. I think it depends on your time horizon and what your goals are. So if you're an investor with a 5-year time horizon and you like 50% drawdowns, then that philosophy works amazing. If you can't do a 50% drawdown, don't do that philosophy. I think you have to split it up, because
Well,
if
what would you?
unless you include in the why, something that has to do with the price action itself. And I think,
Well,
first
yeah,
of
that's what I
all,
was going to maybe ask you about. Is the why is different for somebody, right? Said, okay, I own it because it's a great company and I never want to sell it, right? That's the simplest thing. Versus, we own companies. Why? Because they provide the right risk and return expectations to the portfolio, right? So
we buy stocks to make money.
yes.
And so we want to make money, and if we want to make money, then we need to have, again, an expectation of money, but we also need to know when to split the theory versus the practice. So and whenever we take on a position, when any investor takes on a position, they're going based on some theory and philosophy. Whether that philosophy be, I believe that the value of a company is its present value of its discounted cash flows, and I have a good idea about what those cash flows are. Therefore, I can value it. That's your why. You know, if it's intrinsic value, if you will, is worth a ton more than what I have right now, then that's, you know, a good idea. That's kind of Benjamin Graham way of thinking. I think that's, you know, I think you're right in terms of, if you think in terms of that direction, I think the why does make sense, why you own it. I know great traders who buy purely based on technicals, their why would be something different. It would be the reason why, for example, the reason why I own this particular investment is because it's got all these characteristics that normally statistically imply that you're going to have a move up in the stock. And it may be for a week, it may be for a month, maybe for a year. It just depends on your philosophy. But I agree. I guess I agree with the why, as long as you allow that why to be a part of a larger framework, not just why based on fundamentals.
Agreed. I think we've tried to convey that we try to bring together the two main philosophies in investments, right? I mean, you have the fundamental views and you have the technical views, and then you can overlay the behavioral finance on top of that, which tries to bridge the gap between those two, right? Which is interesting in itself. So maybe we can dive into that maybe for a second, right? We always said that, and I agree with you, that valuation is not an academic exercise per se, but definitely not a closed form formula to say this is what it's worth. This is what it's worth to me. This is what I believe the company's ability to execute on its business is, and based on that and some assumptions on discount, you think this is what it's worth, and it's either over or undervalued by that. We say that technical analysis is more of that, the craft of how do you navigate between the current price, the market price, versus that intrinsic valuation, if you will, right? And this is not a straight line, not because I think it's undervalued that the rest of the market is going to agree with me tomorrow and shoot up to what I think it's worth. So we navigate those 2 points, right? So tell me a little bit more about maybe that, that path, what that path could look like for a stock.
Okay. So the navigating the gap was a great concept. First time I heard about it was I was in New York at the Chartered Market Technicians Association's meeting, and there was some really prominent valuation people there. One professor from NYU who is very well known, and there was a lot of discussion about just that. In fact, the whole title was Navigating the Gap. And that's kind of stuck, actually. That was, 5 years ago? 4 years ago? And that concept has definitely stuck. So I would just tell you kind of my philosophy about selling based on everything, fundamentals, technicals, everything. Just forget about theory and talk about practice. I think that you have to have a predefined uncle point where you say, this doesn't make sense for me to own because I want to manage my risk. And that's kind of the first part of the selling rule. So the first selling rule, in my opinion, has to do with mitigating risk in terms of I'm wrong, admitting you're wrong, not based upon your fundamental view, but based upon what the market is telling you. So you may have a great fundamental view, but the market tells you otherwise. And if you've sized your position in a certain way, you should obviously size it to what you think the risk is that you're willing to accept. Then you sometimes you have to get out of things that could still be good investments, but the timing is not good right now. And sometimes you have to admit that. So I want to point out that, like, right now, we saw a ton of companies that have the fundamentals in place. They're doing very, very well, and the technicals looked good, and they started to move off of bases, moving higher, and they all failed. They all failed. Why? Because the market said, no, we are not in bull mode right now. And so we saw a ton of setups fail. So how long will that last? I don't know. So the first thing is just that managing of the initial risk. Then the next thing would be, okay, at what point am I going to not let a gain turn into a loss? So if you are making good price progress, at some point you don't want to have a round trip. I remember actually a client firing me early in my career, a guy from Texas. And of all things, this guy was he was a fishing guide who got an inheritance. And I went fishing with him. He was a great fisherman, by the way. He fired me because we had round trips. We had a series of round trips. And I learned a lesson about the round trip, that they're no fun. Round trip meaning you buy something, it goes up pretty good amount, and then it comes right back down to where you were and then turns into a loss. And then you're sitting in that loss for a long period of time. It's very difficult to practically build capital when you take lots of round trips. That turn into losses.
Let me just probe a question on that topic. So let's say you did have a great run. So the alternative to making the round trip would be to get out and take that gain. But also some people, and I think this is a common practice, people sell too early their winners, right? And sometimes we hang out to our losers too long, which is really how you get to a round trip. So how do you balance those two objectives?
So yeah, you have to balance it based on the stats. I mean, I like to balance it based on the base rate. So if you look at a large sample size over a various time frames, whatever your time frame is, and if most winners tend to, over a certain period of time, not go into a loss situation over a certain period of time, then you know you have a higher probability you're going to take a round trip. Or if it's not making enough price progress, or if other investments are starting to do a lot better, but this particular investment is just declining or holding its own, then you know that you might be taking a round trip. So this is where why I wanted to talk about the art of selling, because it's not necessarily you can make it purely systematic, which is we try our best to do it that way. But there are the balance between that is you have to understand the volatility of the instrument too. So if you're trading a company that has a daily volatility of 2% a day, then if it's acting normal and we're in a good market environment, then that stock, once it reaches a certain level, should continue higher if it's still in bull mode. If it starts to wane, then you know that it's, once you've gone a certain amount up, then you know that you might be running into trouble. So since you don't know with 100% certainty these things, it's better to scale your positions, both in and out. So rather than trying to pick a bottom or pick a top, it's better to work with probabilities and scale your way in and scale your way out. We're talking about selling, so scale your way out. So balancing that. So let's move down the continuum. So we talked about initial risk. Then there's kind of how do we avoid round trips. So when you have a reasonable profit relative to your risk that you're taking, your initial risk that you're taking, it's a good idea to pare some of that investment off and then let a remainder of that investment go for the long run. And so because over the years, the markets have become more mean reverting. We used to see a lot of continuing trends and smoother trends. We don't see that as much now because there's more algorithmic trading. A lot of computers are moving in, and if you have any resting orders, they're like sitting duck. You're like a sitting duck with resting orders. You have to keep things off of the visibility of the marketplace. So, but you have to give yourself some room with the intraday volatility. So I think that's the key is understanding how volatile something is, how much you're going to let it go up. So, and then also another thing is how is the stock progressing? Is the stock progressing in a way that's orderly, or is it not? So you can have these kind of violations, if you will, where if you have stocks that are moving higher and then all of a sudden they stop moving higher, but there's tons of volume and it's trading in a tight range or drifting downward, that's telling you it's getting into some selling as it's moving higher. And that could be an early warning sign to tell you, maybe I should just be taking a little bit off the table here. So let's say a stock you bought at $100 and then it goes up, let's say it goes up 25%. So it's now at 125. So now it starts getting into it's not really moving anywhere, but there's tons of volume. Maybe you peel off half of the position or a quarter of the position at that time. So it's better to think that way than it is. And the stock may have tremendous opportunity, but where you make your biggest winner, biggest profits are the ones that you hold for a long time, and they go up 100% or more. So you don't want to take everything off, because the big winner, the way it works is that you'll find that most of your profits comes from a few stocks. So if you invest in 30 stocks, probably, it's like almost like the 80-20 rule. It's actually could be even more than that, where 80% of your profits come from, one stock or two stocks. So you got to keep them on. You got to let your winners run. Can you hear me?
Yes. No, this is very good. So you kind of gave us a pretty good template on what kind of what we do on the way up. Now, there's also, of course, the unfortunate but unavoidable situation where things don't work out, because you bought a stock. So how do you, what do we do about those? Can you maybe talk a little bit about our approach to those situations in the early days of a new holdings, for example?
In the at the initial stage, if something moves against you, based on your initial risk that you've set, then you get out, no questions asked. You just get out. I mean, and sometimes you kick yourself because it moves higher, but you can always get back in that stock. So, and one of the things about selling, I think, that always gets everybody upset is that you have to understand when you're dealing with selling that no matter who you are, you're never going to get it 100% right. You will always feel like you never know how to sell, no matter what, because you'll never pick the top. You'll always have a woulda, coulda, shoulda that I wish I would have gotten back in that one, or I wish I would have. That's just going to happen. But you have to remember, it's not perfection what you're looking for in the marketplace. You're looking to make money. So what you got to manage is your return per unit of risk, and that's it. So and you may not necessarily, we're not interested in like, I got to be doing exactly what the market is, and when the market's going up, I need to be making as much as the market is always. No, that's not. We want to make progress. It's more like a stair step. You're kind of going nowhere, then all of a sudden you're on your trends, you move up, and then you might go nowhere. You just don't want to have big downs. Avoiding the big downs is the key, because once you go down 50%, you got to go up 100% to break even. And we're just trying to avoid that.
No, I think we've had a couple of those recently, and it's always hard for an analyst, for an investor to do all the work and buy a stock into the portfolio to see it not go anywhere, or to even see it go down. And I can actually name two that we sold yesterday. We sold Cisco, which a couple of weeks ago I was bragging about like being kind of a great new addition to the portfolio. Well, I sold yesterday because there was some bad news. We had a bit of a leg down on Cisco. It didn't hit our maximum loss, but basically this was dead money, and we're seeing other opportunities right now. So it takes a little bit of
the beautiful thing about that, JP, the beautiful thing about that is yes, we took a loss, but we had a position size that was appropriate, and it didn't have a big hit. We were within our risk parameters, so that's part of the game. And
yeah,
so
it was a very well this one very kind of well scripted kind of entry and exit of that stock. And that's what you want. You want to have a plan, right? I mean, I think everything that maybe I can make a statement on what I'm hearing is when we take a position, we're not winging it, right? We have a plan. We know when we're going to add to that position. When appropriate, we know we're going to peel back from that position and let some of the profit runs. We know when we're going to entirely exit a position. So however you approach that, try to have a plan for action, right? You do not react, and that's when emotion gets in the way, right? We just came out of a few days of volatility in the market, and it's very easy to get wrapped up and emotional about it, and want to sell things too fast, irrationally, for no reason. And that usually happens when you don't have a well thought of plan or a system to make those decisions in a rational and systematic fashion. So
selling into strength is another issue. So you've got selling into weakness, and you could have selling into weakness when you initially buy and it's wrong, your timing's off. You can have selling into weakness when it's gone up but now it's starting to wane. And then but then you have this other issue where you sell because the thing is going exponential. That's the one where I find that people are unable to do it because the greed factor is enormous, especially if you have a lot of it. So like if you had stock options or something like that, or stock grants, and you got it at a discount, and you're worried about the taxes or something like that, and then you have a stock that's trading at 40 times sales, and you still don't want to sell it, and it's 40%, 40% of your net worth. You don't want to do that. So the other part of this is that selling into strength, and that we just came through that period. We had a bunch of them. We had Nvidia, we had Apple, we had, and it was just time to start selling them. So there's a few tips on that. One would be that when the volatility of, we look at the volatility impact of each position. So as you buy a stock and the stock gets a bigger part of the portfolio because it's growing, that every day that volatility is moving up and down, it has an impact on the portfolio, which is basically the kind of the daily standard deviation times its position size of that, at that time. When that starts getting out of whack and it's having too much impact on your portfolio, that's when you need to start thinking about pulling some of that back too. So you have open risk. Open risk would be how much of, since you bought it to where it is now, how much of that profit is open, that is a percentage of your total core capital. If that gets too large, you need to start tightening that up. And so you got to look at it not only from the stock's position size, but you also have to look at it from your portfolio, because we're in the game of making money, right? It's not a game. It's it's really important stuff. But I kind of like to look at it as a game because it's fun. But we have to think about the portfolio too, because sometimes we'll have to sell something because of portfolio rules.
That's correct. I mean, I'm looking at it right now, and I think we were in that position where we were reaching we tried to maintain lower volatility than the market. That's one of our objectives, and that's why we keep talking about risk. So we were kind of getting close to 90% plus of the market volatility, which was getting uncomfortable for us. So we peeled back a little bit, and now we're like more in the 85% range. So if you do have a way to measure that, whatever matters to you, then you can control that portfolio level risk, right? Which was, I think, maybe another important topic for us to discuss is about the reasons to sell. There are some reasons that are idiosyncratic to each stock. So there's a good reason why you want to sell stock ABC or Cisco or the likes, but there's also an overarching portfolio level kind of asset allocation and risk management aspect that can cause you to sell or allocate.
Yeah, you're gonna kick yourself sometimes, right? But in the long run, we know. So we always look at the base rates and statistically, and we're looking at things in the long run. This works. It has shown to work, and we have a reasonable basis that it will work in the future. So I can give you a couple examples of when you kick yourself. Like, so I was looking at the realized gain loss for the year, and I had was looking at one account. We had like an 80% rise in a profit that we realized with one lot on Zoom. And then we got out for portfolio reasons and risk management reasons on a re-entry. And then we did not get back in that stock, but that stock took a huge run afterwards. Now, we still made money on it, but we didn't ride the full trend. Why? Because we had capital at that. By the time those signals came in, we had capital already committed to other stocks. But keep in mind, we mentally account. We go, dang it, I should have had Zoom. But, well, wait a minute. We bought Apple with that, which went up 80%. We bought Nvidia, which went up 80%. We bought these other Peloton that went up 60%. We bought, what was the other one that went up a lot that was a smaller company? I mean, so you got to remind yourself of what's going on here. And people think, oh, I'm a horrible seller because you sold Zoom and it went up another 200%. Okay. But if you have discipline, you're moving into the other realms. And I'm bringing that up because it's really important that you have confidence in what you do as an investor, and that you have, but your confidence is not based on gut feeling. It's based on a process, and it's not always easy. So I will tell you, some of the best books I've read on selling, Market Wizards. Everybody should read this book. This is the new one. Some of the best ones is the first Market Wizards book. That was a really good one too. Lots of ideas, some of the best traders and how they sell. A classic. This is a book. This is Technical Analysis of Stock Trends. This is the first edition. This is an old book. Look how old this thing is. I mean,
Don't look for that. It's really hard to find and expensive.
it's worth some money, right? This was written by Edwards and McGee. There's some great selling stuff in here, and this is old stuff. Some newer stuff would be, look at Mark Minervini's stuff. Mark Minervini has got great selling ideas, but ultimately you come up with your own selling style. One of my favorites is Victor Sprandio. Trading Principles of this is called Trader Vic: Principles of Professional Speculators. Amazing book. Of course, there's a lot of economic stuff in here too, but a lot of the concepts that I've developed over the years has to do with many different disciplines, going back from technicals to fundamentals, and I think that you have to build your own style. And if you're doing it yourself. Now, for us, I mean, obviously people hire us to do this. But selling to me is the key to success. Selecting is important, but when we go back and do back tests, you can see in the simulations that actually the selling is more important than the entry. You can pick a random entry and put a different exit system on it, and it will have more impact on the results than the entry rule.
Yeah, that's correct. And maybe something that we're actively working on right now, which is interesting, is we tend to be more systematic than maybe the average, and maybe we follow some of the people that you just mentioned. But when we look at it, you got to test or have a basis that the rules that you employ do add value and do work on a probability basis, right? Like, we're not right 100% of the time, nor should anybody be in order to be successful. We don't need to be right 100% of the time. We just need to know that we beat the coin toss, and that's what we're trying to prove. And we look at rules that apply over long market cycles, apply across different market environment, across different stock groups, and you want to have the confidence that those rules will add value over time, individually and together, right? That's always one of the things. Like, when you start building systems that include blend even something from a fundamental screening all the way to more technical trading, then you have to say, okay, what is adding value? Is every piece of that value chain adding value, and how, right? And it's very frustrating and tedious to try to get to those answers as we do. But then when you get there, then you have a system that you understand how it functions and how it behaves, and you're not second guessing the system. So that's one thing I wanted to guess your thing is, we always have a tendency to think that we can outsmart the system. So you do all this work, right? And then you put it into practice, and you're like, no way should I be selling Tesla last week, right? Just if that's your favorite stock. And yet, you were down, close to, 40% now. So,
well, we've never owned Tesla, but
yeah, exactly. We don't. No, that's why I don't think.
I mean, I've owned it personally in the past, but I don't own it now.
Yeah, exactly. I mean, right now, I don't think you can have that discussion. I think it's on everybody's mind if they're watching that today, that Tesla, was the golden child, and now took a fall from grace. So, maybe can you tell me how you've negotiate that I guess balance of a systematic approach to things versus outsmarting or discretionary decision in a portfolio? I'm curious.
Yeah, yes, a gentleman here in Colorado who is a great trader told me your worst enemy is yourself. And he's done very, very well over the years as a trader. His name is Peter Brandt. And in fact, I have Peter Brandt signed his one and only book. Oh, actually, no, he wrote 2 books. But the very first book he wrote, that a lot of people don't know about it. I mean, I think if you buy it online, costs you hundreds of dollars to find, if you can find one. But he said that your worst enemy is yourself. And now I do think that the issue with that is that you have to have a method in your discretion. So when you have any discretionary point, at any point in the chain, there's discretion, and we're not 100% hit a button, black box, and do it and let it run. So there are great managers that do that, but they have fail safes as well. So you have to say, okay, where are we going to actually put in that discretion, and how much are we going to allow ourselves to allow our discretion to impact the results? There are times when you have things that happen that are absolutely out of the norm that you need to step in and say, we're going to make a change right now. Like I would tell you right now, like let's say you were a quantitative guy, and you were an asset allocator, and you were doing stocks and bonds, and you were basing it on historical data. Well, right now you can't; those rules don't even apply anymore with the Fed and the bond market, for example. You have to understand the structure of the marketplace. So I would say one of the biggest things where you need to intervene is when you have a structural change. You know, in our career, we've had several big structural changes and lots of small ones. But the underlying principles of quality, valuation, technicals, growth, those don't change. But the implementation of them may change a little bit at the micro level because of changes in the way the markets are operating. So one example would be you wouldn't hold resting stop orders in because you're just going to get pulled out.
Six in the morning,
pulled in
before the market opens. That's correct. Yeah.
Yeah, or the way the markets act in the middle of the day are different now and towards the end of the day, and with all the exchange traded funds, that's a structural change that changes the way we should consider trading, because people are trading more and more based on market cap of sectors and geography and industry than they used to. So I think it's probably some of the biggest changes. That's where those are the kinds of things that you need to step in. And then the other thing is that you have character change in the market. I first heard about the term character change when you're dealing with the market, actually from Investors Business Daily. I was watching a video, and one of their chief market strategists, I forget his name, he used that term. He saw a particular action that said that's a potential character change in the market. That is a perfect way to think about it. In fact, we just had a character change, if you will, in the market recently, because we were on one path, and then we had massive selling, high volume downside. That's a character change. So you have to have ways of understanding how the markets work in general. But to answer your question, you have to have a method for how much you're going to allow and where you're going to allow the change to occur. And it's an art, and we're always working on that.
Yeah. And I think what you're saying, if I can paraphrase or summarize, is we really come in or step in when you look at the overall market and really that kind of intermarket, what's going on, really at the broad portfolio level. We try not to intervene in the rules at the stock level, right? I mean, I may have a feeling like, for example, today I was looking, unfortunately, Lululemon had great earnings, yet is down 9% today. Again, the market reacted on selling, which has been the case. Like companies do great, they outperform, and then it's a sell on the news kind of a market. And you talked about that. This is a sentiment or a character of the market right now. Otherwise, it would be a happy event. It turned out to be not so great, right? So we'll see how we trade around that.
And we have rules. We have in our system. We have how many days till earnings do we have when we enter? Like, we don't want to be entering in around really close to an earnings date. We also will look at whether or not we have a profit around earnings dates, and whether or not you should be getting out ahead of an earnings. If you don't have much of a profit, sometimes your best bet is if something is not working, you've held it for say 21 days or more, and then you're getting close to an earnings report and nothing's happening, you're leaving yourself open there. But if you had something that's gone up 80%, 50%, and the fundamentals look amazing, and you're coming into earnings, you're going to hold it, or you should, if you have no reason, if there's no warnings to get out of it. So, but in Lululemon's case, that's one that's gone up quite a bit. So, and it's that typical buy on the rumor, sell on the news.
Yeah, so that's been that's an example. But right now, I think on everybody's mind, we might be headed into a more volatile market environment, and that's where we may choose to to manage exposures, right? Again, that's a word we haven't talked about, but manage the overall exposure to the portfolio. I think you were telling me yesterday, appropriately, when you look at our portfolio right now, it was an interesting barbell that I called it, where we had and we've discussed before, we have some stocks that are pro-cyclical, where we're positioned for everything is going well and the next stage of the economy, and we still have exposure to the good things of the past, like the Apples of the world that have done well and keep carrying that momentum and performance in the portfolio in the broad market. Well, right now, we might see some changes in this little market turmoil, and understanding that and deciding to either focus on different areas or peel back is also a bit of a discretionary within guidelines. Like you said, you put guardrails so you don't completely become discretionary and overreact to those movements. But I think understanding those risk exposures in the portfolio is very important, and deciding where you want to place your bets, because that's what it is. In the end, we're allocators, and we allocate capital to the opportunities that we see, and hopefully stay away from risks which we don't expect to be compensated, right?
Yeah. And when the overall market decides it's heading into a downdraft, I mean, it doesn't matter what you own. And the more beta you have, the more you're going to get hit, and the more something has gone up, the more it's going to get hit. And profit taking turns it into my current take on the market. By the way, right now is that we've carved out the beginning of a basing phase. So we've had like 4-day sell-offs, and are we down right now? I didn't look.
No, we're up 3% today. So
okay, so perfect, because we had a 4-day sell, and then we hit the bottom of the end. So we've carved that initial part of the consolidation. I don't think we're in a free fall market, mainly because there's the fund flow information that we have, which says there's nowhere to go. And then also the fact that we're in an election year. So, there's a lot of excuses to sell right now. We're in September. A lot of people want to sell ahead of the election. I can't tell you how many people have told me, oh my gosh, we need to sell ahead of the election. And, that's never worked for in my career, actually. I've never seen that really work. But I almost hear that almost every time there's an election. Somehow you're going to have people that think that one side's going to affect and the other side's going to affect, and whatever. But I think we're still in a bull market. And I think the valuations are crazy, and but that doesn't matter. That's my current view. I could be completely wrong. But the good news is that we have discipline that will steer us if that turns out to not be true.
Correct. We let the market inform us and tell us what to do. So we're not stubborn. We're not stubborn fundamental people. So that's the bottom line.
Yeah. So if you're a musician, you ever you learn this concept of improvising. You know what I mean? It's like, hey, play something in the key of A and start jamming to it, or whatever. Jive on it. Or what's that term? Riff. Play a riff in A, and then we'll make a song from that.
Yeah, and I'm a big fan of jazz. I'm actually on the board of a great jazz organization in Colorado. So do support your jazz, your local live music. It's coming back slowly. But just the idea, like even within what sound to the maybe untrained eye as a free form improvisation has a lot of rules within it. I mean, when you look at the musicians on stage, they play off each other, and there are rules the way they play with each other. So there you go. There's
rules. Can you hear that?
Absolutely, it's gorgeous.
Okay, so if you're playing the key of A, or if you're in a major chord, then you know that you have certain things you can do, like G major. That's major. If you're minor, you have different rules, right? That's what we have to do as investors. If we go into a bear market, you might want to turn your volume off and not play anything. I'm sorry to bring the guitar. I made a mistake by putting the guitar next to me.
No, we should do that more often. It's a lot more fun probably than to people than dry investment talk. So coffee and riff should be the new title.
Do a riff, You know, man, I'm up. Did you finish your coffee? I finished mine.
Yeah,
So
I'm down to the bottom as well. So I think
that
it's
must
gonna
mean we
be
need to wrap it up, right?
yeah.
So I don't know. I hope this is helpful for somebody. And thank you for asking questions. And you know, did you have anything that you wanted to say on selling too that we haven't already covered? Or
No, I think you articulated most of our philosophy around it, and I think again, maybe the way people should hopefully extract from this is, have some again the reason why you own what you own, and when those don't fall apart, whether they are technically driven, fundamentally driven, or story driven, just act on it. Have a plan and just act on it. And sometimes it's hard because it feels like you're either saying that you're wrong, which is really not the case. The market just doesn't have to validate you. So act on it and do something. It feels good. I'll tell you one thing about selling. I don't think I don't feel great buying. I mean, when you buy, you just don't know, right? But selling is the one thing you can predetermine before you buy something. You can predetermine when you're going to sell. You can predetermine what's going to happen should the path take, right? So think of selling as really the one thing you control when you take a position, when you take a stock, right? And it this great confidence. And I'll tell you, when you sell sometimes and you rip a Band-Aid off, and hopefully it's not too late. Again, don't wait too long. It feels great. It feels
important.
fantastic, right? So I'll leave it at that.
Yeah, there you go. There you go. Absolutely. I had another thought on there, but I think that's an entire another show. So let's not talk about it. So, dude, thank you so much. And I will talk to you later.
Sounds good.
All right, buddy. Take care.
Take care.